Hey there, rookie traders. Jim Cramer here, ready to break down the wild world of trading, spot trading, futures trading? Sounds scary, right? Don't worry, I got you. We'll tackle these beasts together. Trading can be your ticket to big wins, but it's like a jungle out there. Lots of traps, lots of dangers. But with the right guide, that's me, you'll be swinging through the trees like Tarzan in no time. First things first, let's talk about two main ways to trade spot and futures. We'll break them down Barney style so even your grandma can understand. Ready to make some money? Let's go. Spot trading is as simple as it gets. It's straightforward and easy to understand, making it accessible for everyone. You see a stock, you buy it, boom. Just like that, you become an owner of that stock. You own it right then and there. There's no waiting period or complicated processes involved. Think of it like buying groceries. You go to the store, pick what you need and pay for it. You pay, you get your bananas, you're done. It's a simple transaction that everyone can relate to. With spot trading, you're buying the asset at its current price, called the spot price. This price is determined by the market at that exact moment. You can hold on to it for as long as you want, hoping it goes up in value. There's no rush or pressure to sell immediately. If it does, you sell it and make a profit. Easy peasy. It's a straightforward way to potentially grow your investment. Of course, prices can go down too. The market can be unpredictable, and that's something every trader needs to be aware of. That's the risk you take. Every investment comes with its own set of risks, and spot trading is no different. But with spot trading, what you see is what you get. There's a level of transparency that makes it appealing. No fancy tricks, no complicated contracts. It's just a direct and honest way to trade. Just you, your asset, and the market. It's a pure form of trading that many find refreshing in a world full of complexities. Futures trading is a whole different ballgame. It's not like your regular stock trading where you buy and hold shares. Here, you're dealing with contracts that have expiration dates and specific terms. Imagine trying to predict the future. That's futures trading in a nutshell. You're essentially looking into a metaphorical crystal ball, trying to foresee market movements and price changes. You're basically making a bet on what the price of an asset will be at a specific date in the future. This could be anything from commodities like oil and gold to financial instruments like stock indices and currencies. You're not actually buying the asset itself, but a contract that says you'll buy or sell it at a certain price on a certain day. These contracts are standardized and traded on futures exchanges. These contracts are called futures. Got it? They are legally binding agreements, and they come with their own set of rules and regulations. Futures trading can be very profitable if you're right about the future price. The potential for high returns is what attracts many traders to this market. But if you're wrong, you can lose a lot of money, even more than you initially put in. The risks are high and the market can be very volatile. That's because futures trading involves something called leverage, which is like using borrowed money to amplify your bets. Leverage can magnify your gains, but it can also magnify your losses, making it a double-edged sword. Therefore, risk management is crucial in futures trading. Traders often use strategies like stop-loss orders and diversification to protect themselves from significant losses. Diversification means spreading your investments across different assets to reduce risk. By not putting all your eggs in one basket, you can better manage the uncertainties of the market. Successful futures traders often have a long-term perspective and a well-thought-out strategy. They don't just rely on luck, they use research, analysis, and experience to make informed decisions. So, while futures trading can be like playing the crystal ball, it's also about skill, strategy, and managing risks effectively. With the right approach, it can be a rewarding venture. Remember that jungle analogy? Spot trading is like walking on a path. There are risks, sure, but they're pretty straightforward. You can trip and fall, but you won't plummet into a bottomless pit. Futures trading, on the other hand, is like walking a tightrope. The potential rewards are much higher, but so are the risks. One wrong step and you're toast. Leverage is what makes futures trading so risky. It's like using a megaphone for your bets. Win big, lose big. That's why futures trading is not for the faint of heart, especially beginners. Section 5. Baby steps, starting with spot trading. So, which one is right for beginners? You guessed it. Spot trading. It's like learning to ride a bike with training wheels. You get the hang of trading without the added complexity and risk of futures. Spot trading lets you dip your toes into the market, understand how prices move, and get comfortable with the whole buying and selling process. Once you've mastered the basics, Then you can think about graduating to futures. Remember, Rome wasn't built in a day. Start slow, learn the ropes, and gradually increase your risk as you gain experience. Patience is key in the trading game. Section 6, Spot versus Futures, a head-to-head. Let's put these two trading styles head-to-head, shall we? In the red corner, we have spot trading, the reigning champion of simplicity. And in the blue corner, we have futures trading, the challenger with knockout potential. Spot trading is all about straightforward buying and selling. You own the asset, you control the risk. Futures trading, on the other hand, is about speculation and leverage. You're betting on the future, and that comes with higher stakes. So, who wins? It's a draw. Both trading styles have their pros and cons. The best choice for you depends on your risk tolerance, trading goals, and experience level. Section 7, before you jump in, essential tips for beginners. Before you go all in on any trading strategy, here are some golden nuggets of wisdom from yours truly. Do your homework. This means diving deep into the world of trading, understanding the nuances, and familiarizing yourself with the various strategies and tools available. Knowledge is power, and in trading, it's your most valuable asset. Don't be a sheep and follow the herd. The financial markets are full of noise and distractions. It's easy to get swayed by popular opinion or the latest trend, but remember, what's popular isn't always profitable. Stand apart by making informed decisions based on your own research and analysis. Research the markets, understand the assets you're trading, and develop your own trading plan. Start small. Begin with a manageable amount of capital. This allows you to learn and adapt without the pressure of significant financial loss. Don't bet the farm on your first trade. It's tempting to go big, especially when you're confident, but the markets can be unpredictable. Start with a small amount of capital that you're comfortable losing. This way, you can learn from your mistakes without devastating consequences. Remember, trading is a marathon, not a sprint. Manage your risk. This is crucial, folks. Risk management is the backbone of successful trading. Use stop-loss orders to limit your potential losses and never risk more than you can afford to lose. These tools are there to protect you, so use them wisely. Sleepless nights are for suckers. Be patient. The market will always be there tomorrow. Don't expect to get rich quick. The allure of quick profits can be strong, but sustainable success in trading comes from consistent, disciplined efforts over time. Trading takes time, discipline, and a whole lot of patience. It's a journey of continuous learning and improvement. Stay focused on your goals and don't let emotions cloud your judgment. Emotions can be your worst enemy in trading. Keep a clear head, stick to your plan, and always keep learning. Section 8. Finding your trading style, a personal journey. At the end of the day, the best trading style for you is the one that aligns with your personality, risk appetite, and financial goals. There's no one-size-fits-all approach in this game. Some traders thrive on the fast-paced action of day trading, while others prefer the long-term approach of value investing. Some enjoy the challenge of technical analysis, while others rely on fundamental research. The key is to find what works best for you and stick to it. Experiment with different strategies, learn from your mistakes, and never stop evolving as a trader. Section 9, the bottom line, trade smart, not hard. So there you have it, folks. Spot trading and futures trading, two different beasts, each with its own set of rules and risks. Remember, trading is not a get-rich-quick scheme. It takes time, effort, and a whole lot of discipline. Start with spot trading, learn the ropes, and gradually increase your risk as you gain experience. And most importantly, never stop learning and evolving as a trader. The market is constantly changing, and so should you. Now go out there and make some money. But most importantly, trade smart, not hard. And remember, I'm always here to cheer you on from the sidelines. Booyah! Jim Cramer.